Why do economic cycle boom and busts occur, like the Great Depression and 2008 financial crisis? Number 1, a recession is malinvestment, which is unprofitable and unproductive economic investments being purged away through natural market forces. The 2008 financial crisis is an example. Due to government policy, home loans were required to be given to low-income borrowers who could not afford the loan. Eventually, these borrowers defaulted. Fannie and Freddie, which were government-sponsored enterprises, were buying and guaranteeing the vast majority of these bad loans. Up to 90% of these loans were sold to Fannie and Freddie, even if they originated from a private bank. Once these bad loans were purged from the economy and the losses were realized, the market returned to normal within a few years. If there is an investment mania, like too many railroads being built in the 1800s, eventually the bad investments will be purged and only the truly productive and profitable investments will remain. The fact that an investment is profitable means that the market, which is consumers and society as a whole, values that new investment. The more free market a recession is, the less risk will need to be purged and the faster the recovery will be. Number 2, the government's solution to recessions is to increase demand. This makes the recession much worse. The government sees economic downturns as being caused by not enough demand. Pumping money into the economic system for consumption will solve it, as well as more central planning and regulation to reduce unemployment. Socialists view the New Deal created by FDR in the 1930s as a positive good. This was an attempt to fix the Great Depression. The New Deal was a government jobs program. It also had various price controls for products and wages, subsidies for industries like farming, and various central planning regulations like production quotas. New Deal policy also instituted welfare state-style policies like Social Security as well as unemployment insurance. These styles of policies increase wealth redistribution without a corresponding increase in productivity. They function similarly to money printing. The Smoot-Hawley Tariff Act of 1930 crippled international trade, making the Great Recession even worse. U.S. imports decreased 66% from 1929 to 1933. An important lesson is that government projects, through government jobs programs, are not guaranteed to be economically productive. For example, if the government builds a massive bridge over a river, but it's in a remote part of the country with very little traffic, that spending will not be productive. In fact, the government spending on the bridge project will not only produce a useless, unprofitable bridge, but all the money to pay for that bridge will have to be taxed away from the more productive and risk-cautious private sector, who themselves could have invested into something economically productive. It's twice the loss of capital in that respect. Government projects are not accountable to natural market forces, which are profits and losses. From a socialist perspective, the government is the best planner of economic production. The Great Depression lasted about 10 years from 1929 to 1939. Even in the 1970s, with the oil crisis caused by an oil embargo, President Nixon instituted price controls on oil prices and wages, leading to massive oil shortages. This was an attempt to solve both the oil crisis and solve rampant inflation. Number 3, the Fed, through lower interest rates increasing investment, will amplify existing malinvestment.